Welcome back to VettedVA Live. It's been a minute. This is the first one actually of the year, and we're all the way here in April past tax time. We're trying something a little bit different today. We're doing these 5 p.m. Pacific, 8 p.m. Eastern, a little bit earlier today. See if we can get a little different audience, better time for you guys to participate. We're, as always, going to go through a topic here in detail. And today's an important one. We're going to talk about credit. We're going to talk about how it affects your mortgage, VA mortgage specifically, but about 20 to 30 other things in your life that you will pay a lot more for if you don't have your credit optimized. So if you have questions, credit, VA, mortgage, real estate, anything that you think Chris and I can help with, throw your questions there in the comments. That is the primary purpose of the show. But with that, Chris, why don't we start? This is interesting. I was working on a project myself of a lead magnet, basically a little 2 to 4 pager, breaking this down for mortgage clients to see what the impact is and how to maximize their scores. And about that time, April 9th, I see a Facebook post from you in great detail of all of the ways this impacts you. You want to kind of cover a little recap of what you talked about in that?
Yeah, so I think the great myth is that you don't need a credit score. Credit scores aren't that important, or you can do things even without a credit score. It's like, yeah, it's like there's always a way to get things done. There's always another way to do things if you're not willing to quit, but that's not the point. Most people think credit scores are about whether you get like approved or denied for something, and they're really not. They decide how expensive your whole life is going to actually be in aggregate. And your score controls a lot of those pricing mechanisms, and that price shows up quite literally everywhere. And I made a list of 20, and just 20 that I know of in reality. And I tested them and I checked them everywhere and to make sure. And yeah, so what are those 20? Glad you asked. One, mortgage interest. You're aware of that one, right? A lower score means a higher rate.
Means a much higher interest rate.
A higher score means a lower rate. And so by how much? A significant amount, depending on how far those two numbers are apart. So to say it's prudent to have a higher score than it is a lower score and a no score. Dave Ramsey, oh, you don't need a credit score to get a mortgage. No, you don't. I have access to a lot of those, but ask me to compare apples to apples to the products that have a score attached to them. You'll see the difference of cost in your credit, having it or having it poorly or not having it all represent to you, and the additional cost, which you're so afraid of that you have to carry because of unwillingness to participate in an economy that you're already in. So mortgage interest goes up. 2, PMI, private mortgage insurance. Another thing, lower your score, higher your premium. You pay, that varies in a lot by product, program, or anything else, but anywhere from $50 to $200, pretty reasonable, or more a month until your score, equity, or whatever gets balanced to the point it's not needed, or it's more reasonable or better priced because your risk threshold has decreased. 3, auto loans. Like this one's another one. Gets almost every one of us, right? 620 score on an auto loan versus a 760 score on an auto loan. Maybe someone that's live here can speak to their experience if they've ever bought a car with bad credit versus buying a car with good credit. The difference is massive in auto loans.
10% or more, 10% or more in interest difference for the lower scores, which can be
brutal.
The same vehicle. You drive the same vehicle as your neighbor, you pay $10,000 more easily.
And it's like, oh, but the payment's not terrible. It's like, no, they stretched that out even to a longer term. And so you get into these products, then now you understand why people hate the word debt. It's because they're binding themselves to terms and obligations that cost burdensome because they're afraid to adopt a better practice in the economy of money they exist in, and the mechanisms for risk aversion and control and decisioning that determine what their overall cost of living is going to be. You're in the economy whether you realize it or not. Your credit score is a beacon of you're all in the military, you're in the military service. How you got promoted, what you got promoted for, and everything else was a nature of a rule book, a rubric. Credit's the same thing. You're just not following the rules. And that's how credit works. So PMI, right? Auto loans. That's 3. 4, auto insurance. Yep. Auto insurance. Most states actually allow credit-based rating decisions on pricing, right? And again, good credit, good normal rate. Bad credit, yeah. And at the time where insurance rates are increasing in a lot of places. So again, auto insurance going up. 5, homeowners insurance. This is another place. Poor credit can absolutely means hundreds, if not thousands of more a year in your home insurance. My home policy has tripled in 6 years. Tripled. My mortgage payment, $2,450. My insurance went from $5,500 was the first annual policy I got, and this year's policy was right over $15,000.
We probably should tell people you're in Texas. For other parts of the country, the people are choking on the first figure, the 5,000 figure, but the 15 is probably mind-boggling for a lot of people.
Yeah, and to be fair, this was a house that I bought using a process that I've been doing now for a decade, and the house that I bought 6 years ago today has nearly tripled, or at very least doubled, but probably tripled in value in that time too. So their cost burdens are reasonable. It's like not unreasonable. And there are other things besides just inflation or credit score that impact their cost and increase, right? Value is a big one of them. Insurance burden, because of claims that are having to be paid out on previous premiums collected at values that were half just a couple of years ago of what they are today. So it has to catch up, and that's what you're seeing. Lower credit's going to cost you even more pound for pound there, right? 6, a credit card APR. I don't that one's true. The APRs that you're going to pay on credit cards and the offerings that you're going to get, the terms, the benefits, the ability to, even if you're having to migrate or even if you're having to carry credit card debt for a while, getting new credit cards all of the time isn't a good strategy. But if you have to take a strategy for 3 years to carry debt at a 0% because you can transfer it 1 of 3 years on something that you have a plan that's likely to pay off or provide enough value that it makes sense. If you have good credit, that's very easy to do. So what did it cost you to carry the money? A payment on principal. The money cost itself was free to borrow for 3 years. If you can carry it on a 0% introductory for 12 months kind of a thing. So bad credit, you don't get those options. And so now you carry pound for pound. What is going from 0% to 22 to 25%? What's the percentage increase there?
Well, I mean, look at that. Infinite,
Big
right?
number. It's an infinitely big number. Yeah.
And
It's
if you're carrying
literally
a $10,000 balance, it's a couple $100 a month difference in one
and that's
card.
huge, especially if you're already hurting. Like, look, if you're already carrying too many bricks in your pack, look at the weight of each brick. Like, where can you save size? How many bricks do you actually need? And that's part of the problem is all of these things start compounding. So then they start hating it. And it's like, screw the credit system. Rah, 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 I'm not, rah, rah, I got you already all these. You just rebel. And you know what that does? Well, downward spiral. So downward we go. After credit card, what do we have? Credit card access and fees, period. You might not even be able to get a credit card that gets rewards or access to one. You might have to use secured cards that have a lot higher costs and much less versatility, much less optionality, liquidity usage for when you need it, when you have to have it, even in an emergency, even if the costs are high. You might not even be able to access credit, right? And you might have to pay up front for it. $100, $500 pre-deposited, and that's your credit card. Now you have to have the money to get credit. So it's not even credit. It's you're giving them your money. So they give you a card that says it's credit and they'll report it as credit so you can spend it. That's what bad credit will do. Down further, rent deposits. You don't think rental agreements account for credit score? The amount you pay in deposit, the amount you pay in rent, the access you have to a property or not even, right?
Think about that, Chris. That you're saying just the deposit if you get accepted.
Yeah, lower score, you're going to have a higher deposit.
Well, not only that, that's if you get the opportunity to make that deposit. I have a property here in Orange, California that we did a rehab on. We had 25 applicants. If you have the 580 credit score versus the 4 or 5 or 6 people with 780, 820, you're not even going to get the opportunity to make a deposit.
No, it's here's your security deposit, first and last month rent payable now. You don't qualify for our move-in special of don't have to deposit first and last month. You just have to have your security deposit, right? Because your credit score. And so what does that cost you up front? 2 months of rent. So the costs start to compound a lot now. We're only at 8. We got 12 to go. Number 9, utility deposits. Try those on for size. We're not talking about access yet. We're just talking about cost. But electric, gas, water, yeah, they all check your credit score. Going to in bad credit, $100, $500 up front. Sorry, you got bad credit. We don't think that you're actually going to make good on this. Why? Because on your credit report you see here are 3 other utility bills that you've walked away from in the past. Okay, you made them up after they were settled for a loss. We don't want to take a loss, so we're going to collect up front. And so it costs you more. 10, cell phone plans. Think you don't pay more for a cell phone plan if you have bad credit? Good credit might even get you like 0 down options on buying a phone, not even getting the phone, right? No money down, no need it, pay it through term, no interest charge. Bad credit, now you're paying money down up front, and you're probably going to have to pay more on the monthly service as well, right? Cell phone plans, period. Like, you might just have to go prepaid. Now you're on a track phone because you wanted to listen to Dave Ramsey and not have a credit score, or because you didn't have any other credit reporting things, or because you just have a lot of bad credit that you've not dealt with, because you just haven't taken action, not because it's not hard, it's easy. There are people that'll help. We have a 3-hour course you can take for free. You know, it's funny. I'm going to be honest with you. Every one of you that watch this, most of you will raise your hand and say, oh, we just want to be told how to fix our credit. We don't want to pay $500, $600 for 6 months of work so someone will fix it for us if we just send 3 letters off and settle it. We want to do it ourselves. We built a 3-hour course. They'll tell you every single thing that you need. I mean, I didn't leave anything for chance. But yeah, it's a 3-hour course. Why? You want to do it? I want you to do it right. I don't want you to screw yourself. So take the course, do it yourself. Pay somebody to do it for you. But either way, start addressing your problems because they have big cost to you. And again, we're just on number 10. Cell phones. But that can be significant. And all of this, is anyone going back? Maybe AI can go back and add up all of the additional monthly costs that you're looking at here from good to bad. 11, student loans. Refinancing those. Good scores, again, lower rates, longer terms. Bad score, shorter rates, shorter terms. Right? Or maybe no access at all. Maybe no refinance at all. Personal loans, number 12. APR on personal loans, huge. This gets brutal. You want some, and personal loans get ridiculous. You're talking about like APRs of 1 to 5 introductory, 6-7% to 30%, 35%, like ridiculous swings. And some of this is borderline predatory, but it's optional and you choose it. And so what's predatory if a person says that they're willing to pay it? You have to understand it. And there's lots of disclosures and disclaimers that show you that you do, but your credit score reflects that you don't, or your desire to, like, I don't know. And understand stuff happens. That's not what I'm talking about. I'm talking about knowing what you need to do, seeing what you need to do, believing what you need to do, and then not doing anything about it. Waiting for something, for the next thing, for this unfair thing. Well, that wasn't really all my fault. Pointing somewhere else instead of taking action to fix it. Whatever, it is what it is, and it impacts you massively. 13, business loans. You want to start a business? Credit score is going to kick you here too. Your personal score is still going to get pulled. You're still going to be looked at, even if it's a non-personal recourse type product. You're getting looked at. And bad scores, higher rates, or no loan access at all. I'm telling you, fundamentally, as a sponsor on a business deal, they're going to look at you. It's going to cost you more. You may have to bring in another note sponsor and other partners, investor partners. You may not even be able to go on owner docs at all if it's so bad. Now the business idea and all the stuff that you did to put together, your credit score is prohibitive cost-wise alone because of what you have to put together to make it work. What did I see? It was business loans.
This is a big one, Chris, for your generation, my generation, not a big deal, but the kids these days, 20, 25, 30-year-olds, the buy now, pay later is a big one. And this has probably the biggest difference.
So let's tie it together real quick. Buy now, pay later, and other like fintech apps. If you look like me and sound like me, and there are lots of y'all that don't, that know what I'm getting ready to say too. You remember how it used to work around Christmas time or birthday time for us? The credit we used to get by? Y'all remember the different companies that had layaway plans? Same kind of a thing. Buy now, pay later type tech, fintech type plans. Affirm, Klarma. What are some other ones that you know about? You're more tied to the generation than I am, oddly. But
and the funny thing on the mortgage side, because buyers have been skewing older into the 30s and 40s, we don't see a ton of this. But I had a VA buyer here recently that we had to go through and kind of list out, because you don't see this on the credit report, but he had like 10 of them every month. Thankfully, this was a well-qualified borrower that had good scores. He's probably doing it because he was paying very little to no interest on it. But those are the big ones that we see over and over again. Just Affirm, Klarna, all that stuff.
Yeah.
And it is something that underwriters are looking at and can complicate. It's not going to prevent you from getting your loan, but it's going to complicate things.
Right. We're going to hit 15, then we're going to pause for a little bit of story time. I'll make it real brief. Number 15, though, life insurance. And this is a huge one for me. I use life insurance as a means to store liquid reserve for debt maintenance, security with long-term compounding, access, ability to leverage, death benefit, family legacy planning, trust planning, a lot of things. I get a lot of compounded value out of it. Not in all states, but in some states, credit score is a big part of that. And the way it impacts your premium and the way it impacts your ability to compound the value of your life, depending on how early you start it, because this one's going to hurt you. You all might look at a car as a depreciating asset, but I want to break your heart and tell you actuary tables prove you're a depreciating asset. What's your plan for adolescence for those assets that are attached to you that need you to encounter the nature of your depreciation in whatever way it exists, right? And what limits will credit impose from cost mechanism controls the limit of your ability to grow or pass down legacy things that aren't attached to something you physically hand, but understandings and mentalities of the reality you exist in, whether you accept it or not, right? Life insurance is a big one.
And
So
you'll see, Chris,
breaker,
you'll see people that say, hey, I don't understand that. I mean, because I have bad credit, I'm still healthy. I'm likely to live just as long. All you need to do is watch a couple episodes of Dateline NBC or 48 Hours, and you'll realize how often the people who end up finding themselves killed or killing themselves, terrible things that happen, but oftentimes there's financial stressors behind that. And that's the reason why those actuarial tables do look that way.
yeah.
And it's much worse for people with
You
lower
want to
credit.
get that? Look in the way that what do they call them? So let's just say that you have a permanent life policy, and you aren't going to make your premium anymore, and you're going to let the policy lapse, or you can, or whatever else. People buy those, and then they continue to make your premium after you've let it lapse. They buy those as investments, and they make your premiums. And as an investment, do you know what their dividend point is?
I do not. What is it?
It's when you die. They own your policy. They bought it as an investment vehicle. So those investments exist. You can buy people's policies that they walk away from and own them. And you own somebody's investment on their life in a financial instrument, and you get a return when they die. Who? Instead of their family. It's kind of a little bit gruesome, but it'll prove to you that you're a depreciating asset. Anyways, let's get into story time. That was a little rough, right? But it's true and it's real. You can Google it. This right here, Elon, I covered up the important data. I think this makes me secure on Life Protect. You can see my dirty fingernails because I like digging in the garden. It's flower season here in springtime. But this credit card, not this exact one, it's newer, but it broke a tip. My stepmom helped me get the credit card when I was 16. She co-signed for me. She told me how to use it. I used it for gas only. She checked on me. She hammered on me. My family wasn't a credit company. We was a layaway company. That was the top credit we had. But by doing that and by teaching me how to manage it without me knowing what it was going to do, I've had a 750, 800 FICO score outside of every time, whether it was an active duty and I had to go to a medical facility off-site, or now with TRICARE and there's some sort of copay or something that was never claimed or missed, my credit score invariably during like 4 or 5 loan transactions has dropped 150 points because all of a sudden a medical collection of $12 for a copay pops up. And I never received anything else. So outside of those type of moments, I've maintained a super high credit score my entire life because my family invested, or my stepmom really, in taking the time to co-sign for a card for me and teaching me how to use it and holding me accountable on how I used it. And without me knowing so, that gave me a gift of a thing that I had to take and do something with and protect. But now also a thing that adds value to your credit score is the average age of your accounts, right? 39. Got that sucker when I was 16.
And
Sucker's
Chris,
old.
you're not alone in this. The Wall Street Journal had an article about 3-4 months ago. A lot of parents are doing this for their children at a young age, 4 or 5-year-olds, putting
They'll
them as
go, yeah.
authorized users on
Well,
cards. They can't be responsible for the card, but they can be an authorized user. So by the time these kids get to college, they have a 15-year credit history.
bingo. And that's huge. Now, I've run into a lot of situations where that's been done too for the negative reasons, because parents suck sometimes, right? So don't suck if you're a parent and you know that you can do those sorts of things, and like that's fraud anyway. But you're right. It's a gift that you can give them that's very easy, as long as you can give a little bit of discipline and behavior pattern to them. And that's the legacy that matters even more than the score. The score represents your behavioral pattern over time with when you've been extended credit according to certain credit rules, right? That hold everybody's calculation inherently the same. And so whether you like it or not, it's a reflection of your pattern, of your actions, of your choices. Even if you have examples or excuses or there's wrong things or whatever else, and there is sometimes, but either way, that's why it determines so many different things. We're on 15. There's only 5 to go. And we're just talking about cost things right now. We're not talking about like utility loss functionality things, right? Which are part of some of the stuff we've talked about. But 16, let's get into this point. Auto lease approvals. Everyone got to try to get an auto lease with bad credit. You're going to have a higher down payment, you're going to have a higher payment, or you're not going to be approved at all, right? Rental applications are the same. I know we talked about a little bit with rentals earlier as far as deposits and everything else, but you get denied totally for your score, right? You're going to pay for the right to be denied, $50 to $75 for the application. And you're going to continue to do that over and over at how many places until you find one of them willing to rent to you. So even in just the applying process, what are you going to spend because of your bad credit? And what did that cost you a month? Every year you had to renew, or every time you defaulted and had to move and renew early with something new on there. That's a hidden cost. It's like, oh, I don't want to spend $150 on a credit report, credit card payment. That's stupid. I'm letting that go. I'm going to default. It's $800 I ain't got anyways, but now I'm going to go spend $200 applying for apartment complexes with bad credit. For the sake of winning the battle, you're losing the war. You're stepping over dollars to save quarters. You're focused on defense instead of playing offense. Everything's happening to you instead of you choosing to happen to whatever is in front of you. And that's the part about credit that most people don't like to accept, right? And the cost that comes with it. Rental apps, just in rental application fees.
And it's a true thing, Chris. As a landlord, I'll have a vacancy once a year, and you're going through this, and I have people, you can see it in their eyes that they'll just say, do I even have a chance? I'm gonna tell you what my credit is. Do I even have a chance? Because I don't want to pay $40 for the app for pulling my credit and all that stuff. And that's unfortunate. It's hard as a landlord to look, because you want to give people a shot. But at the same token, these numbers are predictive. They do tell you how likely someone is to repay you in a timely manner.
They are. And I'll tell you the truth right now. Like, I see the default numbers I see the risk profile numbers. All of that data is public. You can look at it too. And here's the thing that none of y'all want to accept. You don't want to accept that a 480 FICO score is a representation of who you are and how you behave financially. Even though the patterns are all real and based on your choices, regardless of the circumstances, and you've done nothing to change them, right? And like it's all you. The pattern choices were you. The score is a reflection of your behavior. The score determines your cost. You don't want to look at the score because you don't want to look at yourself and your actions and be accountable to them. And even if you aren't completely accountable, who cares? They're your responsibility. Remember what responsibility is there, veteran? Ever been in charge of a lance corporal or whatever you had in your branch that did something stupid that you specifically told them? I know it's like staff sergeant. I told them specifically, don't do this stupid thing, and they did it. It's like, well, they're corporal. Sorry. Who's responsible? It's like, hi, staff sergeant. Like, that's the nature of it. You're responsible for whether you deal with it or not. You're not dealing with it, and that's why it's prohibitive and costly. And until you accept it as a reflection of your behavior pattern and a representation of your overall risk for someone that going to extend you hundreds of thousands of dollars based on your choices in the future of what you choose or not to choose to do, whether you can or can't, or it happens to you or not, realize that there's a reason why. If it looks like a duck, it quacks like a duck, it acts like a duck, it's got yellow feathers, it's got a bill, it's got orange feet, it lays eggs, its DNA says duck, it's probably a duck. Like, you don't like it because it's true. Don't let it hurt you because it's true. Fix it. Make some other thing true. So moving on, because I don't want to make you just feel bad and run away from this whole live, which is probably what
But
I'm
Chris,
doing.
instead of just making someone feel bad, let's look at it this way. Part of the beauty of this is it is only a snapshot in time. If
Yeah,
we take,
it's true about your history, your past, not what you're doing today or tomorrow. It's true until you make it just by one simple choice and action to prove what you believe, to make it untrue. And then it starts becoming more and more untrue. And the more and more untrue it becomes, the higher your credit score goes. Even if you get things deleted from it to make it less untrue immediately. You get 3 collections off there. Bloop. Oh, it's less untrue that he was a butthole because it's all gone. Oh, he's been making timely payments. Oh, took out a big debt, repaid it early. Oh, personal loan was good too. Oh, 5-year history of being on time now. Let's go ahead and let him go to a 780. It takes time, distance, direction. It takes compounding of time, of activity and action to get to something. And you already all know that. You just have to compound your choices, even when it's hard, especially when it's hard, because that's where the breakdown happens. And that's, as soon as you interrupt that compounding, it's just like the value of a dollar compounded. If you interrupt it, it's less valuable. If it's uninterrupted, it's exceptionally valuable. A marriage uninterrupted for 50 years is exceptionally valuable, especially the two that have it. Not because they went through anything harder than you, but because their compounding never got interrupted, right? All of our things, all of the activities, and all of the actions we take are acts of creation. What are you creating with your action? A score is just one representation of it. And these are the costs that the representations in reality that everyone else can observe, regardless of what's in your head, have a real tangible cost to you. So realize that your history doesn't determine your future, but your actions today and tomorrow do. So what are those going to be?
Chris, we've got a comment here from a member of the group. Jeremy says, I think one of the biggest credit confusions I've encountered is community property states and what is required. My wife's not on the loan. So on conventional loans, not a problem. But on a VA loan, if you're in a community property state, if your spouse has bad credit,
Not just VA, government loans.
Government loans, it can be an issue for you. So my wife's not on the loan, but is going to be on title. Therefore, they do pull her credit for credit worthiness, and you can get hit with her past debt and not get approved. So you were talking about something important, the compounding of 10 years, 20 years, 50 years on credit and in your marriage. It is important that you're aligned with your partner on how you're managing your credit. Let's say both of you have a 580 credit score today and you say, I'm done, I'm sick, I'm tired, I am going to fix this. And in 3 years, you have that 750 credit score. Just like Jeremy said, if your spouse is still the 580.
That's a fight and a big hardship in a marriage, because here's what's happening. One person's made choices and actions to correct what they see as bad behavior and action that's harming themselves. And the other person's not aligned with what they're doing. So they're not moving ugly together, which is still actually good because they're together, they're spouses. But now one of them's moving towards what's true. They're not moving ugly together. One of them's moving towards reality and what's true, while the other one's not accepting what's real and what's true. And how many times have you seen in a mortgage, in a refinance, in a new build, in a credit challenge situation where one spouse is active to try to fix and the other one is reluctant? How many marriages have you I've seen 3 marriages fall apart in like live during transactions, and how many divorce attorneys are referral sources for mortgage people? It's a difficult process because it's one that forces you to look at something big, that's important, that projects over time, that requires action and activity to obtain and sustain together to achieve. And so it's incredibly meaningful. And if one partner thinks that and the other doesn't respect it with actions, it becomes a hardship. And that's super brutal to see. Stay aligned with your spouse. Here's what I'll tell you. If you know how important it is to get your life together and have good credit, and your spouse isn't there yet, work on your stuff, but just accept that your stuff's going to be ready and waiting, and you're going to live a sucky credit life until they get there too, because it's better that you stay together with bad credit mentality than it is that you grow apart even if you're financially broke you can be happy, whole, and have so much more value out of life with a marriage that goes 50, 60 years than you can with money and good credit. I'm not saying that happiness comes from good credit and money. It doesn't. You'd be happy either way. But in a marriage, it's really important that you stay aligned here, and credit can become a huge problem. Please don't let it. Like if you're a spouse out there and you're ready to work and you're ready to grind, you're a me. If you're the spouse that's not ready and it takes time, and even when you see what's real and true, you have enough uncertainty and you don't know if you can do it, and you don't want to act and believe, you're still frozen, fog of war, fear, whatever. That person needs time to react. And if you move before, you leave them. Even if you're right, you leave them. And that's not leading. That's choosing not to let somebody have the opportunity to follow and dictating it be on your terms. And in a marriage, don't do that. So accept the bad things too. But man, it's important that you align on this too. So sorry, that was a little too much, but no more sermons. Marriage is important, okay? Anyway.
Very important. For your finances and your happiness.
Well, this is the truth. No, I'm going to go into it further. Everyone says money doesn't solve problems. Yeah, you know what? You're right. It doesn't solve all problems. But I'll tell you this. You know how many marriages I've seen fall apart because of financial hardship or massive financial gain? Because there was always an underlying problem. But when marriages aren't worried about how we're going to pay the mortgage, how we're going to cover the car payment, how we're going to cover the kids' tuition if one of them's smart enough to go to school, which they're probably not, but we should probably think about that. How are we going to cover if you're not having to focus on defense all of the time, what might you be able to focus on that you want to do together? Offense, building, creating, not reacting to, but happening to things together. A lot of marriage problems happen because of financial disparity shows the lack of alignment that exists yet, or more importantly, the lack of skill set to realign when things happen that cause misalignment rapidly and on important things. And that's where too early financial hardship destroys marriage. And there's so many optionality things now that are safety nets or repair plans, or there's like so many backup plans that you don't have to stick it out because you have to. But then if you do, you realize that if you just stick it out because you accept that you have to, then it really was never an issue anyway. So money doesn't solve all problems. Good credit isn't going to make your marriage last forever. But man, not having to be afraid of making a payment on your mortgage or your car, or not having to like put back half of your groceries halfway through the freaking tally up. Don't like a lot of people look at this office and my circumstances today and they think something that's foolish. I think I'm speaking from the top down from a perspective that isn't their own, that's better than them, that, oh, you can't possibly know now, Mr. Fancy Office with your Weller display. People aren't intimidated because of my tone. They're intimidated because of my certainty, because their uncertainty can't possibly believe that my uncertainty is reality. Things change because I changed. My patterns changed. My decisions changed. Plenty of them still need to. I have a lot of work to do. But I remember what that feels like. It wasn't so long ago, less than a decade. Like, and even still times in that, major needs because of how hard we push on trying to grow. Because when you start with very little to compound from, nothing, if everything isn't compounding, where the heck do you think you're going to go? You're going to go on complaining and feeling like a victim and feeling like you were robbed and like something happened to you simply because you never just laughed twice and said, nope, I'm going to happen to it. All you have to do is pretend, guys. It's make-believe. Credit's a make-believe thing. Money's a make-believe thing. It's all real because we all decided to believe it is. Make believe with everybody for a little bit. Play along. Shut up and color. Whatever you want to call it. And better your circumstance because it's not hard. And your history doesn't define you, right? But you got to take action. Yeah, I don't know. You got a little bit long, a little bit hot here. But this part it kills me, man, because I see so many people capable. And so many of them complain, and so few of them let that anger do anything. So they sit there and they complain, and they suffer, and they hurt, and they blame, and they do nothing. They just sit there. It's like Tombstone. You're going to skin that smoke wagon, go to work. You're going to stand there and bleed. They're going to stand there and bleed and talk and get slapped twice and shut up and talk more because that's financially what's happening to them. And it hurts to see people choose that. And that's what, and I've been there, and I've been wrapped by this mentality that says I'm poor because I fail to believe something different. I fail to practice and pay the cost of changing my habits and my actions. That's it. That's what poor is. Mentality you accept.
Well, several other things that you said there as we listen to you. Responsibility, you said, and talking about responsibility, being responsible for leading for others. Accountability, which is just personal responsibility. No one ended up with a bad credit score without taking actions and not taking accountability for where it was going to take them. But the decision to move forward and be accountable, this can all be fixed. Where I was going with talking about this, your credit score is a snapshot of a moment in time. And if you don't like what that snapshot is now, there are steps to be accountable going forward that can and will fix this. So a lot of times with government loans, VA and FHA both, people reach out and they go, okay, I saw that VA doesn't have a minimum credit score, or I can get a VA loan with a 550 credit score. Say, can versus should. You can, but should you? Let's talk about what's going on here.
Hey, shoot, man, they're about to say, no, it's bare minimum Monday, y'all. Let her fly. It's not going to hurt you. It's just going to cost you because, by the way, you're saving all your money. It's like your strategy's failing. Don't put in the bare minimum because it's going to cost you through the teeth, right? Like, it's costing you everywhere. You have to see it. Like, they have to see it, right, Josh? At this point, I mean, we're not even, I'm sidetracked here. We're about through banking access is number 18. We got 3 more. And then there's utility thing. We don't have to go through all of that, but I want to hit them. I'm going to hit them quick. We're going to rapid fire these because they're already like, dude, this redneck loudmouth is preaching. Yeah, whatever. It's all truth. Prove it's untruth, and I'll shut up. And I'll apologize for talking too much to you. But I don't care otherwise. You need to listen. So you shut up and listen. 18, banking access. Bad credit and might not even be able to get an account, right? Second chance checking, no overdraft fees, no line of credits. None of those things are going to exist for you, right? At all. And now you're going to have NSFs. And now you're not going to be able to qualify. Again, another problem because credit. 19, cosigner dependence. Don't like being needy. Don't like being looked at like you're incapable of doing things on your own. Don't like being treated like a child by other adults and businesses. Change your habits and the things that reflect your actions over time. Here's the truth of the matter. One more story before I go. Cosigner dependence. Don't be dependent. 20 car rental credit. Like car rentals, you're going to pay more if you have bad credit, or you're not even going to be able to get a car rental at all, right? Or you're going to have a huge $500, $600, $700 deposit on top of it. I told that story earlier about those 12. I'm not exaggerating. $12 copays while I'm getting a mortgage, drop my score while I'm actively in a loan, 120 and 160 points one time. Every vet out there's like, well, that's not your fault. Yeah, it was. Yeah, it was. Because when I was at the doctor's office, I know they do copays, and I didn't go, hey, do y'all have a copay? Cool. Can I just pay that now, please? Yeah, how much is $12? You know, I just happen to have $12 in cash. I've got 14 actually. I mean, big spender. I've got cash. Let me pay that now. So when that happened, guess what? It was a reflection of my action in time. I knew a thing exists, regardless of whether it was going to be right to happen or not. I knew it was likely to happen. It had already happened, and I didn't do the thing that I could have done because the pattern I knew was real. I didn't take action. It was my fault. That's my point. It doesn't matter if it's absurd. It's the nature of reality, and I didn't play along. It was my fault. People can't accept that because they're too victim mentality. They have to blame someone else because if it's their fault, they have to fix it. I don't want to fix it yet. So those are just the cost things, okay? Real world consequences. And I'm going to go through this faster. 1, denied housing completely. 2, lost job opportunities completely. Government jobs, security clearances, all of that kind of stuff. 3, delayed utility access or no utility access by yourself completely. 4, shut out of banking access potentially and many of the mechanisms required outside of you having massive amounts of cash, which is, by the way, the problem to start it all over with. So you're going to do something illegal to do a bunch of cash and try to get back in the game. There's another rabbit hole that's going to work out well for you. 5, subprime everything, not subprime lending. Subprime loans, guys, wasn't the loan. Subprime is a nature and a character or credit risk, a character of the consumer. Subprime everything's you with bad credit. It's a cost you pay. Subprime is a character risk of your profile, not the loan. It's you.
And you
You're
don't
subprime.
want anyone to consider you subprime anything.
Subprime
You want
everything is
you to
what you
be
get.
prime.
That's your real world access. You're subprime everything. That's you, Mr. Subprime, Mrs. Subprime. I'm not trying to hurt you. I'm trying to help you. You got to hear the truth. It's not just your score isn't just a number, guys. It's a multiplier of cost and of options and of your reality that you're going to be able to take advantage of, or that's going to have to take advantage of you, because whether you realize it or not, it takes a little bit to exist at all. And you have to play the game regardless of whether you want to play it to some degree. I'm not telling you have to do everything. Don't want to have credit? Get a secure credit card, manage it well for 12 months, keep it for a few years, use it every once in a while like you should to show some activity on the dang thing. You'll have a great credit score. It'll be thin, but it's workable. It's not going to crush you everywhere you go, right? That's better than, oh, yeah, I don't need a credit score. Dave Ramsey told me. I read his book, his podcast. He's a millionaire, smarter than you. He doesn't have a beard. He doesn't have an accent either. He's got a lot more money than you. His house is bigger. Trust me, my financial plan's better than yours. Dave said so.
I think the important part here to leave you with,
Sorry.
everything that you just,
tired.
all of the stuff that you just walked us through is 100% true. And this isn't just to say, hey, if you have a 580 credit score, these things are true. I'll give you an example. Chris, in January, I did a refi on a rental property that we had. We needed to do a debt service coverage ratio loan on it and make it quick, fast, and easy. Well, we had taken a vacation at Christmas time. So the credit card was at like 60% of the limit instead of 10% of the limit. And it knocked that score down 35 points, and it cost us 0.25% in interest. So now, as long as I have that loan, I'm paying, $300-400 more a year than what I need to. So is it the end of the world? No, but it's a voluntary tax for not managing my credit optimally.
Man, I had really good credit. I've maintained good credit all of my life because I realized early on, as a broke kid that grew up 1,500 foot just right over there. My house is right over there. Broke as in, like, I don't need your, it made me who I am. I love it. Didn't need a lot. Realize that. Still realize that. This doesn't matter. But, oh God, I just lost where I was going with that. What'd you say? You triggered me. Trigger me again.
We're just talking about managing your credit and the cost of even losing just a few
Well,
points.
sorry, I
even when you
managed
have a
credit.
high
I made
credit
sure
score.
that I had good credit, and I had good credit all along, so it allowed me to do things differently, right? Dave Ramsey saying, "Oh, it's having a credit card's terrible idea." Meanwhile, I bought a house with zero down, with not great credit, with not a lot of money in reserves, with holes in it as a short sale with a VA loan that everyone said it couldn't be. A whole bunch of things everyone said I shouldn't do, I couldn't do. It didn't work that way. I did it, and meanwhile, because of what I know about real estate, I grew up a framer's son. My dad still frames houses, right? I know what houses can create. So I know how to create value with a house. So I start taking things like I didn't have any money, but I had this Chase credit card that I had for a long time, and it had this zero introductory balance, and I hadn't put anything on it in a long enough time where it was anything I put on it was like a new special. It was like 2013, somewhere in there. Remember that time frame. Credit specials everywhere, basically. Use credit again. We need to make the economy breathe. And so it was like, well, honey, let's do a couple remodels. Let's spend like 30 grand on the credit card. I can manage that for 6-12 months. I can pay it off aggressively with a couple things that, I was just getting into being a loan officer. And you know how it is. Like, 3 months of the year, you're not for sure how you're going to eat. And 2 months of the year, or, the rest of like all but 1 or 2 months of the year is pretty good. And then 1 or 2 months of the year, it's like every night you're just going to eat steak because, winter's coming or something, right? And so in those feast moments, it's like I would hoard all of the capital in back to paying stuff off. So I'd carry on my credit card 30, 40 grand because they had a balance of like 60 grand, which is scary, y'all. And I'm telling you, it was scary, but I was disciplined in how I used it. And I had backup plans, and I had other backup plans, just like I would in the military. And I had a plan for the worst case, and I had a plan for the best case. I had a plan for everything. And I practiced things. And I saw how other people did it in my reality. And so I was able to daisy chain that debt along to where the cost of money was free for me. And that house I bought for 332 grand and invested about 100 grand into over 5.5 years, of which maybe 20 grand was cash. The rest of it was credit and paid off, which all went back to principal. It came back to me, by the way. It's forced savings. I sold it for 810 grand. When I bought that house at 332, it was the most expensive. I felt like I can't say that word, a jerk. I felt like somebody was trying to pretend to be something he wasn't. A kid that was too big for his britches. A kid whose ideas were just dreamer. He's never going to learn. Because other people's small mindsets captured me. And the mentality that they took to money, to debt, to credit, to dreams, the discipline around action was poor. They didn't invest in it. But I did. It didn't cost me anything, even on the credit cards. And I made a ton of money from it. And that habit built other habits, got me to here. Bought this place for $742. 10,000 square foot house, 100,000 gallon pool, 1,100 square foot guest house over a 1,300 square foot oversized garage, 13 foot tall. And I bought it for $742 with a VA loan. Or no, I had to go conventional on that one. Long story, transitioning, W-2, self-employed, different states. You know how that drill goes, right? But I made it work. Co-borrower. Was needy, even though I had good credit. But I had a partner paid him. But anyway. Now, 6 years later, without really just maintaining it, it's kind of a maintenance, a little bit of a maintenance woman here on this place. You know, the bigger they are, the more they cost. That sounded bad. Houses, y'all. But I still don't think it's untrue. But actually, that's not true, probably. It's inverse. Whatever. It doesn't matter. The house itself, it maintains, there's maintenance cost in it. So it's not like I haven't had an input cost to it. But right now, trade for my county appraisal just came back in, which I'm going to fight because I don't think they can prove it because I haven't seen it to prove. I mean, emphatically, I don't think it would trade it even though the market would prove it. But it should trade from where 175 to 2. My house payment's $2,500 a month because I locked it in on a refi at 2.25, and I paid some stuff down, and I owe $540 something now. And all I did was use credit, y'all, because I didn't have money. I had to learn to use credit because I was a broke kid. And I realized that even the people with money, they didn't use their money for this kind of stuff because credit was cheaper. Because debt over time, if it's fixed, becomes less heavy because of the nature of money itself. Money stored value from yesterday that's already lost a lot of value. It has to compound just to exist. Don't believe me? Put $1 in your pocket and save it for 30 years and then try to spend it 30 years from now. You didn't do anything. You didn't invest. It compounded. And it's almost worth nothing now. Y'all remember when you buy a Tootsie Roll for a penny? I saw the other day Tootsie Rolls were like 50 cents. Talk about inflation, y'all.
Maybe we'll save that one for next week. We'll talk about
Tootsie Roll inflation.
saving, investing, and inflation, especially when it comes to candy.
That's just credit, right?
So
credit's the first place that limits people's mindsets, man, because they fail to realize that it's a reflection of their actions and patterns in a financial representation over time. And if they're unaccepting of a reality that everybody else can observe, even if they don't want to, they're delusional by definition. I'm not calling you names. I've been delusional. That $12 copay took me a while to realize it was my fault. I think this is the first time I said it.
Before I give you the chance to close it out and wrap things up here, let's point out a couple things that you mentioned very early on. Whenever I come across someone with credit issues and they want to improve it, I am very keen to tell them there is no company that's going to do anything you can't do for yourself. You absolutely can do it for yourself. You pointed out we have a 3-hour course here in VettedVA that will walk you through everything you need to know. And Nathan was kind enough to pop in and say that it's actually hours of credit education of everything that you need to know. So there's companies out there that can help. We can help you with, but you can do it on your own. You can go right to that course, and whether it means you're at 5.
That phrase.
A very big difference there. So every little step you can take is going to put you in a better place, and it compounds over time, exactly like Chris said. So we'll get a link here. This is out in the group. We'll make sure.
Is this going live in VettedVA right now?
We did get it in there. Where was an issue with it when we first went live, but yeah, it is in there live, so it will be there for people to view.
Is anyone actually still watching right now?
Jeremy was here. Jeremy was here watching us live. It did get to the group one time, but what we'll do is it'll be posted there, and we will make sure we get a link to that course for any of you that are interested in optimizing and maximizing your credit. Jason Rivera says, yeah, it is streaming in the group right now, Chris. But with that,
are we going to edit this thing and like put a front label thingy on it and stuff?
We're gonna have to talk to Barbara and see what she's
Or do we
doing. Maybe
normally just put the
she's gonna.
live into the YouTube and stuff like it is?
It's on YouTube. It's
Yeah, the
definitely, we have
title,
no problem streaming to
the
YouTube,
title
so it's
needs to
there
say
now.
something simple like, "Hey, vet, does your credit suck? Watch this video. Hint, it's your fault."
So we'll make sure Barbara gets that done. But beyond that, any additional thoughts, final pearls of wisdom you want to share for everyone?
If this video hits you in the mouth and somehow you make it to this point because you're ready to be hit in the mouth that many times because you're ready to get serious about taking action, you're not alone. You're not going to be alone every step of the way. We've got somebody that'll walk with you, that'll talk to you, that'll encourage you, that'll show you the next step, that'll help you do the next step. We've got people that if you pay them a little bit, they'll do the next step for you. We told you and show you exactly how to do it yourself. You're not alone. Doesn't cost you anything if you don't want it to. That's the nature of this place. We'll serve your interest and needs. But I'll tell you this, not being honest with you about what you're unwilling to recognize about the reflection your credit score has on not only cost multiplier in your life, but the access mechanism. I care too much about you not to tell you that, because not telling you that isn't serving you, it's serving your delusion. And I won't do that. So if it hurts you, probably supposed to. If it doesn't, attaboy, give it a like, holler. You didn't make it this far anyways. No one ever does. But I have fun and I'm still going strong. You think I'll ever be on Joe Rogan's podcast? A 3-hour, I could talk to Joe for 3 hours. I could.
Well, Joe will keep firing questions at you.
Would anyone care then? Would I even care? If they didn't care, nope. I'm just gonna be out here as a nobody. Josh, I appreciate your help doing this. Until everybody starts listening and acting like they give a dang about what they're complaining about, man, because complaining without solution and action is just whining.
Well, this is what we're going to do. We're going to be back every Thursday with another sermon until we get this polished and Joe decides to invite you over to Austin and have you on the show. So we appreciate you taking the time with us. Appreciate you writing that post out on Facebook. Hopefully it's caught some people's attention. Again, it's got to be the right point in time to catch you to decide to do something differently. So hopefully you've seen that. You've seen the content that we have here, the things that can help you. Anything's possible. You just have to make a decision and believe you can do it.
Yeah, tell Joe Rogan if he's listening, like, you want an interesting podcast, I'll give you 30 scriptural quotes that Dave Ramsey and all the Christians use to explain money and debt that have completely confused all of y'all. And I'll show you exactly where those scriptures have been misused and molested to change to cause you to believe a thing that's not true, because they have been. And I've thought through and written that out actually too. And I can go much further than 30. I just figured I'd let you tap on 30. So that could be fun. I don't know. What do you think you'd talk about? Guess we should let everyone go. I've got other calls to make. Work doesn't stop around here, but I enjoy this stuff. And at the very least, if the people reach out to me, they know that I'll take this much passion and vigor to helping them solve their problem, because that's what I'm here for. I don't do loans here. They know that. You can't call me to do a loan if you watch this. It doesn't work that way.
Perfect. Well, hey, we appreciate you taking the time. We appreciate those of you who actually found it in the live stream, in the group. If you have questions, post them there. The moderators can follow through and add additional content. How'd you do that, Chris?
It's an AI camera. It's an AI camera. If I move my hands wrong, it does different things for influence. So it's supposed to like track me and follow me and stuff like that. If I raise my hands.
Chris wanted the zoom in there. But anyways, we appreciate you guys being here. We'll be back next week with another topic. If you have questions, throw them in the comments. The moderators will be watching this and can get you the answers you need. All right. Thanks a lot, Chris. We'll see you next week.
See y'all later. Crazy camera. Bye.